Imagine the oil market drowning in excess supply, yet prices stubbornly holding around $70 a barrel. What's really going on in this turbulent energy landscape? This October 2025 oil market report from the IEA dives into the twists and turns, revealing how global stockpiles are building up, production is surging, and demand is playing catch-up. But here's where it gets controversial. Could geopolitical tensions and supply chain disruptions actually be stabilizing prices in ways that defy traditional economics? Stick around as we break it down step by step for a clearer picture of the energy world today. The oil market has been swimming in surplus ever since the beginning of the year. To put it simply, an excess of supply means more oil available than what's being used. And this has mostly shown up as stockpiles of crude oil piling up in China and natural gas liquids accumulating in the United States. By September, though, things shifted dramatically. A big jump in production from Middle Eastern countries, happening at the same time as seasonal dips in local crude demand, sent export volumes soaring to levels not seen in 2.5 years. On top of that, strong shipments from the Americas flooded the market, resulting in oil sitting on tankers at sea increasing by a whopping 102 million barrels in just 1 month. That's like adding 3.4 million barrels per day to the global float. For context, this is the largest such buildup we've witnessed since the COVID-19 pandemic shook the world. As a result, Brent crude futures averaged a modest uptick of 30 cents per barrel in September, settling at $67.60 per barrel month over month. But by early October, the sight of all those tankers out there, combined with fresh trade policy announcements, drove prices down by $4 per barrel, landing them at around $64 per barrel as I write this. And this is the part most people miss. Global oil supply leaped forward by an enormous 5.6 million barrels per day in September compared to the same month last year. OPEC Plus nations were a major driver, contributing 3.1 million barrels per day to that growth. This happened because the group as 8 producers reversed 2 million barrels per day of their previous output reductions, while countries like Libya, Venezuela, and Nigeria all saw impressive upswings in their production. Under their most recent accord, OPEC Plus is now poised to boost output by an average of 1.4 million barrels per day for the whole of 2025, and then another 1.2 million barrels per day in 2026. Meanwhile, producers outside OPEC Plus are gearing up to contribute 1.6 million barrels per day in 2025 and 1.2 million barrels per day in 2026. With the United States, Brazil, Canada, Guyana, and Argentina leading the charge. That said, there are some risks clouding this outlook. Sanctions on Russia and Iran are ramping up geopolitical tensions, and ongoing assaults on Russian energy facilities have slashed crude processing there by about 500,000 barrels per day. This has led to fuel shortages at home in Russia and reduced exports of refined products. The ripple effects aren't global. Buyers of Russian middle distillates like diesel and jet fuel are frantically sourcing alternatives, which has pushed up prices for those fuels worldwide. In fact, margins for refining light sweet crude reached 2-year peaks in Europe and 18-month highs along the US Gulf Coast and in Singapore during September. Shifting gears to global oil demand, the third quarter of 2025 brought a welcome rebound, with consumption growing by 750,000 barrels per day year over year, after a slower second quarter where it only ticked up by 420,000 barrels per day. That second quarter lag was largely due to trade tariff upheavals, particularly impacting liquefied petroleum gas and ethane feedstocks, which saw a rare drop-off. The third quarter gains align nicely with our annual projections of about 700,000 barrels per day of growth for both 2025 and 2026. Even with this recent slowdown, the petrochemical industry, think plastics, chemicals, and materials used in everyday products, is expected to take the lead in driving oil demand forward. Why? because challenges like sluggish economies, more efficient vehicles, and the booming popularity of electric cars are creating strong headwinds for traditional road transport fuels. Against this backdrop of tepid demand growth and rapidly expanding crude supplies, global oil inventories have built up a 1.9 million barrels per day surplus since January. Yet, surprisingly, crude prices have bounced around $70 per barrel throughout 2025. This price stability has been partly maintained because natural gas liquids have been the main culprit in the oversupply from April to August. In fact, outside of China, the crude market actually tightened up during that period. Looking to the future, as those enormous volumes of seaborne crude start unloading at key hubs, we could see crude stockpiles swell even more, while natural gas liquids inventories begin to decline. However, the ongoing shortage of Russian refined products, upcoming European Union bans on imports of fuels made from Russian feedstocks, and recent shutdowns of refinery capacity might keep product markets, like gasoline and diesel, tighter than the overall supply picture suggests. For beginners, consider this. It's like a seesaw, where one side, crude oversupply, tips heavily, but the other, product constraints, keeps things somewhat balanced, preventing a full price collapse. Now here's where we stir the pot. Some analysts argue that relying on OPEC Plus and a handful of countries for production growth could leave the market vulnerable to sudden disruptions, potentially fueling inflation or even energy crises. Others counter that sanctions on Russia and Iran are a necessary step toward global stability. But at what cost to consumers? Do you think geopolitical maneuvers are artificially propping up oil prices? Or is this just the natural ebb and flow of a maturing market? Share your thoughts in the comments. Do you agree that petrochemicals will dominate demand? Or is there a counterpoint I'm missing? Let's discuss.